Hello, everyone. Happy New Year to you, and welcome to the first Rocket Lab Weekly of 2024. So we have Matt with us, who is practically basically a co-host of the show, and I really appreciate that he's here every week with us. And you have me, of course, and we have lots of exciting topics to talk about. And I hope everyone's 2024 is going really, really good. I've had a pretty tough couple of days. Both my wife and my kid is sick, and yesterday I was sleeping with my 3-month-old daughter so that my wife can sleep, and she is not used to sleeping with me, so she was like having a party and kept me up. So if I happen to fall asleep, Matt, you just kick me off the stream and you just take over.
We'll do. Hopefully I don't have to do that, but
yeah. And then on top of this excitement, I don't know if you saw my tweets. We had an Airbnb guest, or like a family, disappear on us in our Airbnb, which was looking like a thriller or horror story. Basically, just quickly, what happened is we had a family book a few nights with us, 2 adults, 2 kids. And they wanted to extend their stay with 1 night, which we allowed. They paid, and then the cleaners went the next day, and their car was not there. But when they went into the apartment, all their stuff was open and in place. We were unable to reach them on the phone, and we have a smart lock, so we checked like when they left the property. And we saw that this last night they didn't spend at our property. They left at 2 p.m. in the afternoon, which was very, very suspicious, because if you pay for the hotel and you have small kids, and it's extremely cold where I am right now, it's minus 10 degrees Celsius, which I think is, can it be 0 degrees Fahrenheit? Something like it's way below freezing. Yeah, I don't know what it is in Fahrenheit, but it's freaking cold. And so the time was going and we couldn't reach them. We had to escalate the case to Airbnb, and they couldn't reach them, and we didn't know what to do. And at 4 o'clock or 5 o'clock in the afternoon, I decided to call the police and file a missing person report, because we didn't know if they got killed, got into a car accident or whatever. And then the police answered and they said, oh yeah, we arrested these people, and so you don't have to worry about them. So at least the riddle got solved, but we had some Airbnb guests that got arrested. So that's pretty crazy.
That's pretty wild, man.
Yeah. Has it ever happened to you on your Airbnb?
Nothing other than people leaving some small stuff behind. But other than that, nobody's ever been arrested. So
yeah, this is the most exciting we have had it. Yeah, I guess it comes with the time.
Yeah,
it's a numbers game. You get crazies.
Yeah, for sure.
Cool. So let's go over into Rocket Lab. And I think the first topic that we can start with is Rocket Lab has released a new 8K, which is basically a form that companies have to file with the SEC when they have things that materially impact, or something that investors need to know about, basically. And this 8K was shared on Twitter as usual. First, that's how I found out. But I'm not sure a lot of people have read it. It's very complicated in its language, and there is some interesting points in it. So Matt, have you read it, and what did you find in it?
Yeah. So it's not too difficult. One of the new things that I kind of had to work through, which wasn't too difficult, was kind of this rate factor. I'm used to normally seeing, normally used to seeing kind of like an interest rate or an APR or something like that. So we can talk through that just a little bit. But overall, I think it's a good opportunity. And I think later on below, a little bit off the screen, you see, for anybody that is unfamiliar with kind of where Rocket Lab is with respect to their financing and their cash on hand and everything of the like, they have about $385 million on hand, but they also had an upcoming $100 million loan due back to Hercules Capital or whatever, Hercules something. And that was kind of due June or July of 2024. And so this later on, we'll actually talk a little bit about if you go scroll down, but we don't have to at the moment, but it'll talk about how some of the payments of the 70 million that the initial draw was, and then the subsequent 40 million allowed them to be able to pay that back. And so that has now since been terminated. So that means that, really they're able to borrow this credit facility out to the 2029 timeframe, which is a good opportunity for them. Just knowing that they can pay it off and use it as they see fit. And I think that this is going to be a little bit more flexible for them, because that was a 3-year window. So I think it was from like mid 2021 to 2024. And now obviously this extends us out to 2029. So it's a good opportunity. I think that what might be confusing a little bit is how there's like an initial term of like, let's just say 5 years or so, but then there's subsequent $30 million opportunities that they can draw out at $10 million at a time. I think what that basically is they wanted to get basically that $100 million loan that they owned Hercules off the books and just like get it done and, not have to worry about it anymore. But then also they need access potential to help with working capital as they have to build, let's say, a neutron rocket or an electron rocket. And so I think this will be good. It's not necessarily a, what do I say, like an actual structured loan, but I think it's more of like a credit line, it feels like. And then you also alluded to a little bit about the warrant. So I don't know if you want to touch into that a little bit as well.
Yeah, I mean, okay, the warrant for me is in connection with the rate factor. So I did a little bit of digging, and because I've never heard this rate factor before, and my understanding is that it's basically like an interest rate, but I mean, it's just expressed not in a percent, but it's expressed as a number that is usually like 1 point and then something. So, and then what you need to pay back, like let's say if your rate factor is 1.1, then if you borrowed 100 million, you need to pay back 110 million. This is what I have found. Right. And what's really confusing here is that they don't write if this rate factor is yearly, monthly, or for the total amount of the loan. And I was thinking, because basically it almost looks like they have a 2.2% interest on the loan, which is extremely, I mean, it's below the Fed funds rate. And then I was thinking, okay, maybe this is the monthly interest, but then it would be like a 26% interest per year. And I'm like, that also doesn't feel correct. And then I was thinking, okay, then there must be some other benefit for this company. And then I tried to Google if this Trinity is a shareholder in Rocket Lab, and that's why they're helping them, or there is a warrant part in the contract. And I was like, okay, now it makes sense. But then when I was reading the warrant part, so basically you can see it here. I'm highlighting it, but my highlight looks super sucky. So it's basically saying that they are issuing 728,835 new shares of common stock of Rocket Lab, and this company basically gets it if the share price is over $4.87, and I calculated it out, and it's $3.5 million, which is a very small. It's like a 3.5% extra interest on the loan, on like if the whole thing is paid in a year, and this is over 5 years. So what am I missing? Did I miscalculate the rate factor, or is this a too good to be true loan, or is it?
So yeah, I'll touch on the easy part first. So the warrant piece, it's rather small, like you said. It's nothing too extravagant. If you think about it, there's 400 some million shares outstanding. This is less than 1 million shares. So in that respect, you're talking about, less than 0.2% dilution of the stock if they choose to exercise them, right? They don't have to, but I anticipate that they probably will, because I think at a 487 price, by the 2027 timeframe, it should be okay, right? So that's about what 4 years down the road from when they signed it, and I anticipate in 4 years' time we'll be closer to a 10-15 billion dollar stock easily, in my opinion. So I think in that respect, it's pretty simple. What were you saying?
Yeah.
Sorry.
No, I just realized, that I was stupid in my calculation, because if they get this 3.5 million, but the stock price is, let's say, 10 or 15, then it's actually like a 12, 13 million payment that they get. So then what this means is that this Trinity is very sure that the stock price is going to go up. But
yeah, this is a favorable piece. So going back to the rate factor, what this is saying is the initial loan of about 110 million that's kind of being pulled out. That is specifically at a rate of 0.022266, which means they're paying just over 2% of the loan back per month. So if you think about it in that perspective, if you're paying back that much per month, you times that out by 60 months because it's a 60-month loan. Then you can basically say, all right, well, over the life of the loan, they're going to be paying about 34% of that. And then all you have to do really is then take that opportunity and kind of divide it out. And you can recognize that it's in between 6.5% and 7%, which is actually a pretty favorable loan. It's not too dissimilar than what Hercules provided. I think Hercules, their loan was about 7% or 7.5%. So for the interest rate environment that we're in, or the, I guess, macroeconomic environment with elevated prices, to be at this 6.5-7% interest rate is pretty favorable. And that just goes to testament to show how people believe in the future of Rocket Lab. I could see other companies in situations like this that could easily be being charged, 11-12% on the money that they get loaned out. So I think really this just goes to show the belief that Rocket Lab will continue to persist and do a really good job going into the future.
Yeah. And I guess that then their upside, because it's a very, very favorable loan, is the warrant where they get shares. And if the stock price in 2029 is, I don't know, 25, then this was a, let's say, 12% return on the loan for Trinity per year.
Right. And Trinity's they're not really like sharks or anything like that. They do venture capital, they do equipment financing, they do a lot of other things. I don't know much about them other than the research that I did, probably in the last 2 hours. But it looks like they work with a lot of smaller companies. So they work with like Matterport, they work with Hut 8, which is a Bitcoin miner. They work with CleanSpark, which is another Bitcoin miner that I know like Emit and many others are big fans of. So yeah, they're not strangers to this environment. So it didn't seem like that they were trying to truly, I guess, what's the word I'm looking for? Be like loan sharks or anything like that. So anyway.
Cool. I'm sorry. we have the police calling us regarding this Airbnb, so I might have to go. What a fucking cycle.
No worries.
My wife just came to me. But anyway, so we continue the live stream as long as we can. Okay, cool. So all in all, I think this is a very positive for Rocket Lab, because this was a worry about their liquidity, and they handled it really well. And it's a very, very favorable, very good for the liquidity of Rocket Lab, and it just eases the fears of them running out of money. Or do you think there's any negative with this contract?
No, I didn't read the warrant part, so I appreciate you bringing that to my attention. And I was kind of scared because I was like, crap, did I miss something out pretty big? And because I read the first kind of upper parts, and then it started getting into more like the jargon of like the legal stuff associated with it. My eyes started glazing over. So you reminding me this morning, like, is this convertible? To me, it's almost like nothing, right? I think a lot of people might be concerned about dilution and stuff of the like. Just from this one alone, it looks like, they were able to get away scot-free with only a dilution of 0.2%, which to be honest, I understand why. It was probably one of those last little things that Trinity threw on the table. They're like, yeah, we want to give you these favorable rates, but we also want a little bit of skin in the game, right? And they're like, fuck it, it's 0.2% of the float,
It's a
right?
good
Like
deal.
it's not, yeah, it's not a big deal, right? So, it's unlike what Dutch Bros and stuff just did, which is like a 6%, 7% dilution. So I think that this is favorable. I think that the interest rate is pretty favorable. I'd like people to check my math though. Because one time I did the calculation and I saw that I got 7%, and then another time I did the calculation, I got 6.75%. So I don't know if I'm entering the wrong numbers or what, but
it said on the last part of this 8K that they will publish the contract and the actual figures in their annual report, which is coming, I guess, very soon. And then on the annual report, they basically have to publish the percentages. So that's when the full truth will come out. But
yeah.
As long as
another thing is though, Vince, is like there was a piece in there that they basically said this is the initial loan. So that initial loan is like that 6.5% to 7%. But say they pay that back, right? Then they have like the equipment ones, which is like 30 million at a time, and you have to get them in $10 million segments, I guess, just to like make sure. Those are subject to potentially different interest rates. So that could be something that's where they make the real money of maybe charging 10% or 12% or something of the like. And they're subject to different schedules is kind of what I'm seeing. So initially it's kind of like you get this 110, $120 million draw. That's at 6.5%, 7%. And you get a little bit of skin in the game. And then the real money is when they actually start paying off some of this stuff and potentially do those $30 million draws over time. And that part is kind of like a little bit over my head. I was trying to like read through it and dissect it, but it was kind of getting confusing as to like you can't take it all 30 million at once. You have to do $10 million segments. And I was just like, whatever, this is getting too complex. But regardless, you're getting more to line of credit rather than from what I take from this, which I think is a testament to the company and where it's headed. You're getting more towards line of credit rather than specifically like convertible debt, which, you might have to take a 10, 15% hit or something on the dilution.
By the way, this is very good for us because, as I was saying, the best way Rocket Lab could handle their liquidity and future financing needs is with a loan, because none of the shareholders get diluted, right? It's a bit risky, but if the company is very confident in their future cash flow, it's the best on the long term for investors, right? So this is like actually the dilution that they give here is insanely small. Like this $3.5 million of dilution of a 2-point-something billion company is extremely favorable.
Yeah, I agree.
Cool. So then we can go into the next news about Rocket Lab, which is that they scheduled an investor day for Monday, where they were. It's funny, again, it came on Twitter first to my attention, and it seemed like maybe it's about a new contract, and we didn't know exactly what it was. But then when you read this, it's basically to explain the $500 million contract that they recently received. And I personally don't know what there is to explain about that contract unless there is some very bullish nuggets that they want the investors to know, but I have no idea what that can be. So I turn to you, Mr. Matt.
I mean, let's just talk out loud, right? I mean, we talked a little bit about it, when it came to the conversation last week before the end of the year. And with that, it's up to $550 million contract, 490 or so million up front. The rest of the 20-some million is in option payments. Divide that by the 18 spacecraft that's being provided, it's about $28 million a piece, right? So what the hell can you do for $28 million a piece? It's very expensive. We know that Electron is $6 to $7 million, sometimes up to $8.
But the launch is not included in the contract.
Well, that's what I'm saying. I mean, what I'm saying is, it's like for each craft that you're getting in here, you're talking about, $28 million worth, right?
Yeah, that
So
does sound
what
very,
is that
very exciting.
specifically, right? Like,
Yeah.
yeah.
Yeah, I mean, I was thinking when I saw that what, because when you read the 8K of the contract, it was also like the production and operation of the satellites. I don't know how much money it takes to operate satellites, but I guess it's not for free. And I was thinking, like, what if the satellite itself is like 14 million, and then the 7 years of operation with all the crew is the rest of the money? But I'm really not sure. We need to get all the data about it.
Yeah, I'm not 100% sure. All I know is that it's a really good contract for them. I'd love to see the numbers on it. I don't know if we'll get more color on that on Monday about the gross margins that we should expect, or more color around what type of spacecraft. Is it going to be a brand new sort of craft? Is it going to be photons? Is it going to be, basically working with, in collaboration, Space Force to be able to, because at the SDA, Space Defense Agency, that's specifically a Space Force kind of subset, right? So are they gonna work directly with Space Force to create brand new type of satellites? Is that why it's so expensive? Yeah, I don't know. I don't know the answer. It's going to be very interesting.
But why do you think that they feel the need to call an investor day for this? And because their earnings is soon, right? So if it's a simple thing, they could just like take it up on the earnings call. Like, why do they feel the need to schedule a whole different event for this?
It might have a bottom line impact on what's going on in 1Q in terms of revenue, because they said part of it was being worked on immediately, right? So it wasn't like, and so I don't know if that's been factored into 1Q. Maybe it hasn't, and maybe that's the opportunity, or maybe it's just the fact that it does have something to do with Neutron, because these are starting in 2027. So at that point, you have the opportunity to have it be in collaboration, potentially, I'm not saying guaranteed, but potentially, with the Neutron launch. And so is this the ground workings of getting us to that place? And maybe it's just adding more color, right? So I don't know. Maybe it's an opportunity for them to talk about the contract of the financing that they just got as well. I think there's two big nuggets there that they really can really address, and I think they might not have enough time to do it in just a normal investor report, right? Because generally those are 30 minutes, and then there's 30 minutes of Q&A questions, and then they call it. So providing some color to this would be useful, and I think there's a lot more to it. There's a lot more. How do I say this? A lot more retail positive sentiment that I've seen since the last launch. Like, why after 45 launches is everyone starting to get super excited? Why after this $515 million contract and all this, now people are starting to get excited? Why has it taken it since the first launch in 2017, 2018 timeframe to get to the place where people are starting to get on board? And I think that there's something more going on. People are starting to recognize what's really starting to happen here, which is this is a pretty important company in the future of not only space exploration, but it's going to be an important company for space defense and for the United States and their allies in general.
Yeah. And by the way, exactly in line with what you are saying, I wanted to share some very interesting tweets this week. And this is definitely one of them. This chart is basically showing. Sorry?
I missed this one. This is cool.
Yeah. So it was Dave G who shared this on Twitter, and it's basically showing each rocket company how many launches they have had per the first year, second year, third year, fourth year, fifth year, sixth year. And the red line is Rocket Lab, and it's their Electron rocket. And the blue line is SpaceX Falcon 9. And as Dave G also wrote here, that Of course, the Electron is much smaller than the Falcon 9, so it's not exactly apples to apples, but Rocket Lab deserves way more credit than it gets. And you can see that if you look in the timeline, like Rocket Lab is actually doing better than SpaceX as for the cadence, but obviously SpaceX has had more years with their rocket than Rocket Lab. And this is based on, like this last chart is based on their estimation for 2024. But still, it's a very, very surprising and interesting chart. And maybe this is why there is more and more retail attention on the stock, because my experience is whenever I bring up Rocket Lab, it's like, why are you even looking at anything other than SpaceX? They completely dominate the space. And, maybe when people have seen how much, experience and contracts and satellites and everything Rocket Lab has done, they're like, okay, maybe there is a very solid number 2 player in this space. Matt, you're muted.
Sorry, my barbecue alarm is going off. Temperature's dropping. So, yeah, interesting kind of conversation. I always thought that they were maybe going slower than I anticipated, but I think, I think maybe I'm not giving them enough credit as they deserve.
Yeah, exactly. So now let's check some other tweets of the week. This one I thought was very, very interesting. It's by a guy called Space Talks, and it's because I'm sure all of us are wondering, we missed the launch in 2024, which was supposed to come. So that should be imminent. And when you go on Rocket Lab's website, there is no next launch. So we are all like, okay, we're supposed to have like 6 launches, I believe, this quarter, plus the one from last quarter. And we should see some announcements. And this guy pointed out that one of the customers of Rocket Lab actually started a counter on their own website for the Electron launch, but Rocket Lab hasn't done it. So it looks like this is the next launch. We don't know why Rocket Lab is not showing it on their website. I think Matt has gone to handle his barbecue, obviously. And yeah, I really want to see the launch announcements, because this is definitely something that can derail Rocket Lab. That, they made all this fuss that this year is going to be 22 launches and maybe more than double their launch cadence. And then, yeah, where are they? How come we don't hear about them? So this is very cool to see. Then the next tweet of the week is by none other than Matt Farley, and his H1 2024 prediction that we will see a mass influx of retail investors into Rocket Lab as the launch cadence increases. And I definitely think that this is a very good prediction, because for some reason people love rocket launches. I mean, this is what got me to fall in love with SpaceX. I'm fully expecting this also, that Rocket Lab this year is going to get a lot of retail attention, especially if the launches are going good. And then on top of it, maybe they announce that they're close to profitability with certain contracts, and, maybe a Neutron getting ready for a test flight. So it's going to be very, very interesting for our lovely Rocket Lab. And we are getting ready for a very interesting topic that I want to discuss with Matt. So I definitely want to make sure that he's back for this, and that is option trading on Rocket Lab. And it's very interesting because Matt opened my eye to something regarding option trading, which looks like it's going to make me quite some thousands of dollars this year. And I definitely want to share it with you guys, but this is in no way financial advice. Options are very, very risky, and definitely don't do anything with them unless you know what you're doing. So I thought that this segment could be just explaining, what effects it would have to write put options, call options, buying put options, call options, and what are the risks and what are the pros and cons for this year. And until Matt comes back, I can just say that the reason why this came up is because I don't have extra money to invest into Rocket Lab right now. I know that I have my portfolio together with my dad, and I know that we are going to send more money in towards the end of 2024 or the beginning of 2025. And because we have quite some money in this portfolio, we have quite a substantial margin possibility. And what Matt basically said in the last Rocket Lab Weekly is that when he doesn't have money, he writes put options. And basically put options are an agreement that you would buy a certain stock at a certain price if the price falls below it, and you get paid for waiting, right? And I asked him, like, how can you write a put options? How can you write a put option? Because then you would need to have money on your account to secure the put option with. And he said, no, I can use my margin. So in case I get put the stocks, then the broker account would just use the margin, and then you just have to fill up the broker account. And I got like an aha moment, because I'm like, I know that we're sending money to the broker account, and there is January 2025 put options that we could sell, and we would get money on the portfolio, and we would wait. And last time I checked, depending on if it's a $4 or a $5 strike price, for example, on the $4, the premium was 70 cents. So that means that we would get paid 70 cents for every stock. And usually the options, or not usually, the options contract are 100 stocks. So 100 times 0.7, we get paid $70 for each contract that we write. And if we get put the shares, our price for the stock would be $3.30. And my question is, would I be willing to buy Rocket Lab shares for $3.30? And my answer is a definite yes. So I have a very hard time seeing how this is a bad deal, or how this is something that we shouldn't take, because we basically get to use the house money, get paid for the contracts, and basically wait to have the opportunity to buy Rocket Lab for $3.3. And most likely, I highly doubt that the stock price is going to reach below $4 in the beginning of 2025. So most likely this will just expire worthless, and then we just got paid for writing the options. So I really owe a huge thanks to Matt for pointing this out to me, and I really wanted him to be part of this segment, but he's out handling his barbecue. So until he comes back, because I do want to talk about some other versions of this. I know some of you have call options on Rocket Lab, and for example, Francisco, I believe he bought $10 call options. And the reason why I wouldn't want to do the call options is because they can expire worthless. And I rather just, if I risk money, I rather just own the stock outright, because you might be right. It's just, I have seen a lot of stocks been around, especially in 2023, and stocks definitely have the ability to go down, or another thing is that you expect them to go up in a linear fashion. And for example, Tesla was a stock that went sideways and then it 10x'd. So in that case, your call option would basically expire worthless, even though you were correct in your thesis. Matt is back. How's your barbecue, my man?
Good. Sorry, yeah, I just ran downstairs. I think I ran out of pellets and needed to load the hopper really quick. So my fault. Had to run to the garage and get more pellets for it and everything. So it's my fault.
No problem, no problem. So I had to start this section. I really wanted you to be here. I started talking about options and how I'm very thankful that you opened up my mind to, because I don't have more money currently to buy Rocket Lab shares. And you said that whenever you don't have money, you write put options. And I was like, how the F can you write put options when you need to secure them with cash? And you were like, no, I have margin on my account. And then if the options get exercised, then, you know, your account goes minus and then you just anyways fill it up.
All right.
And I have this curious situation that I know that I'm sending money with my dad to the broker account in the beginning of 2025. And I was like, okay, there is these put options for 2025 January that I could buy for the strike price is $4 or $5.
Right.
And if we get put the shares, it results in a price of below $4 for Rocket Lab. And I was like, it's almost like, I don't know, a glitch in the matrix. Like it's almost like free money, because it's like either we get paid for the options or I get the privilege of buying Rocket Lab shares for a below $4 cost basis, and both of them is a yes please, yes please. So it feels like I can only win on this.
Yes,
unless
no.
I'm missing.
I mean, you're not missing something. I mean, you're not mentioning the downside risk, right? If the stock price goes to zero, say Rocket Lab is a complete falsehood, they made up all their contracts, it's not really a real company, and everything that they've sent to the world over the past 5 years is AI generated, and you just find out that the company is a complete farce, and it's not real. Stock price goes to zero. Guess what? You still have to buy those shares at $5. So
true that. But
so you're obligated, right? So that's part of the reason why you can't really think about it as free money per se. The way I would look at it is if you were to potentially buy that stock anyway at those prices, then yes, I think where a lot of people will do, which is a rabbit hole most people go down, is they'll say, let me lock myself into this contract until January 2025. And they'll be like, it's free money, right? 50% return, what have you. And sometimes that's not necessarily the appropriate thing to do, because one, if you write shorter term options, you're going to get way more bang for your buck, generally speaking. Yes, it's going to be more work, but at the end of the day, I think you'll end up being able to return much more over time with respect to that. But I think you can't really look at it as free money. You are still taking on a risk. The stock price could go back down to the threes, and here you are having to buy it at $5, right? So, you kind of have to recognize where.
Yeah. I just want to say that the 5, they have a premium of $1.2. So that would mean that I'm buying it for $3.80.
Mm-hmm.
But it's correct what you're saying, and it's true. Like honestly, if Rocket Lab would go down to below $4, like I would probably use the margin on my account to buy some of the shares, and then if after that it goes to zero and I have missed that it's a fake company and they falsify everything, then I feel like I deserve it.
Yeah, I mean, so a lot of people would talk about spreads and stuff, right? So one of the things that you can think about, though, and this doesn't just apply to Rocket Lab, right? This applies to every one of these particular things that we talk about. So there's credit spreads, there's debit spreads, right? Amit talks a lot about his debit spreads that he has for Robinhood and stuff of the like. You can also do credit spreads. So in this particular case, if you think about what you're exposed to in the contract that Vince is talking about, $5, let's say you are able to walk away with that $1.25 in premium from that, you're buying it at $3.75, then technically, you're exposed to $3.75 per contract, right? Because every contract is 100 shares. So say you write 10 of them, you're kind of exposed to $3,700 per contract or per lot of 10, right? So what you could do, if you think about it, you could look at if you buy a put, what is the $1, what is the $2 strike price going for? Hell, what's even the $3 strike price going for? And so you could look and say, all right, well, in this particular case, let's just call it 5 cents for the $2 strike. Well, now you're only really risking, $3.75 minus $2. So you're risking $1.75. So in this particular case, you're able to walk away with $1.25 in premium. You're only risking $1.75 in this particular case of an opportunity. So you're kind of limiting yourself on the downside. Now, of course, that obviously impacts what your return might be, because no longer are you getting the $1.25 in premium, you're getting $1.20 or whatever in terms of the credit that you're receiving, because you're using some of that to buy. But at the same time, you're not buying it at zero, right? You have a downside protection at $2 or $2.50, what have you. And so it's the same exact sort of idea as to like a debit spread that allows you to lower the amount of capital exposure. It's just in reverse form. And so that's something to consider in this particular case. I think a lot of times people open themselves up, specifically in these like very risky, volatile positions and stocks. And the problem that I see a lot of times, and I'll just get into this, and I'm curious to hear what Vince has to say. You're able to see what your 100% return would be, meaning like you're able to see what your max return is. Vince is looking at this from I'm going to make 50% on one trade, or not 50%. What is it? 25%. I'm going to make 25%, and I guarantee that in a year. And it's like, well, that's 100% what you're at. You could potentially lose, 3 times that if the stock goes to zero. So I think that sometimes people will lock in things and be like, I'm going to do it January 2025. It locks in 25%. And that could be, the right thing to do. But some people might look at the January 2026 and say, well, I could get 40%. Well, it's like, well, in this particular case, it's like you're looking at a 40% return. You're locking up, say, $5,000 worth of capital to sit there. If you're saying doing 10 contracts. And what you could have done is just bought $5,000 worth of shares, and the share price would go up to $10,000. The share price would go up, to $10. The share price would go up to $15. And in that particular case, instead of getting a 40% return, you're getting 100% return, 200% return in the same time period. So you kind of have to be cautious as to what you're really doing and what objective you're really looking for. Because most times it's just a better opportunity for you to just buy the stock outright. And in some cases, right? I'm not saying it's all the cases, but you really have to think about this from a perspective, right? Just because that 25% is there doesn't mean you should go after it, right? Maybe it's a better opportunity for you to just buy the stock itself. And so I just want to caveat that that's not necessarily just a Rocket Lab conversation. That's just an overall portfolio management perspective and portfolio management thing that I've incurred, because I used to do a lot in like 2020, 2021, when I was really starting to get into options. I did the same thing on Palantir. And I was just like, well, let me write this $10 put, and let me write this $15 put. And I made money on them, but if I had just said, fuck it, let me just buy these Palantir Leaps or Palantir X, Y, or Z, it's like I would have made way more money, right? So you have to think what specifically.
Matt, can you hear me? It sounds like you cut out. I still don't hear you. Maybe can you guys comment if you hear Matt or if you hear me? I'm gonna go on YouTube and check.
We are live.
So,
Decided to go live straight away. I'm sorry, everyone. We have had a lot of technical.
let me see if I can hear myself. Okay, yeah. Yes, there was something with Matt. So I'm sure it's some technical issue and he's coming back very soon. And to answer what he's saying, it's very, very correct. And I'm very happy that he's pointing out the risk. And the selling put options, I think it only makes sense if you are writing the strike price is something that you would anyways buy at. So if you're basically saying that I'm waiting for Rocket Lab to go below 4 and then I'm ready to buy, and you have the money ready, then basically when you write a put option, then you get paid for waiting. Like that's the only thing that happens. And again, the risks in this is that you are wrong and the stock goes to 0. Hi, Matt.
Yeah, sorry, it kicked my mic off. I don't know why.
Okay. I wasn't sure who had. I was thinking maybe
it was me. No, it was me.
Okay, but basically to answer your question, I'm very happy that you're bringing this point up about risk, and it's easy to fall into the trap of locking in this gain. And my answer to that is that selling put options only works if you would anyways buy at the price that you're writing it out at. So let me show you what I mean. I made this table of this is the expiry of the put options, and you see that this gets closer to present time, and this is the strike price. This was the last price of the option. This is how much it would pay you, but it's like you can plug in any number here. It's more like the return that matters, what cost basis it gives you, and what is your annualized return. And this is, as you can see what Matt was saying, that the closer you are to present time, like the higher your return, right? And then it's very easy to say that okay, the $5 2024 put option would pay me 32 cents, and that's a 47% annualized profit. So I will write that for the income. And I feel that that's a trap because I'm not sure that I would be buying, because like if I had money, yes, I would be buying Rocket Lab at $4.68. But if I'm using margin and doing something crazy and I'm basically bridging in money that is coming next year, I want to have like a better and crazier opportunity, And if I go look down, like, yeah, 3.9 is something where I'm like, here I feel like I would go a bit crazier and use my margin, but it's only paying 18%. And on top of it, if the stock price of Rocket Lab goes to $10 or $15, and I only wrote an option to February, then in March, nobody is going to be buying an option for a $4 strike price, So I kind of feel that because the price is so low and we have had some red days, like there is a chance to, write these 2025 January calls, which would have a strike price. If I would take the $4 one, the strike price is 3.27. And I feel that is such a low risk for me, because at that time I would anyways be buying hand over fist Rocket Lab unless the company is failing or something. And again, it's not the highest return. As you could see, it's one of the lowest return on the table, but it's the one that I feel the safest with.
Well, I think this is where I think a lot of people will get into a trap, because a lot of people were able to, unfortunately, I think, especially people that joined in the market maybe in, like, let's just say the last 18 months, they were fortunate to join when the market returns were going to be very easy, because 2022 was already such a bad year, and it hit so many stocks where they were down 70, 80%.
Yeah.
And so that return that you saw in 2023 is, I would say, artificial, right? I would not expect 100% returns like I think a lot of people do anticipate. Even great investors are lucky to get 25, 30% returns over, say, a 5 to 10 year period. And so being able to lock something in like that is actually a very good rate of return, but I think you have to recognize what the risks are associated with it are. And I think you might have some people out there that will go for those risky opportunities and look at like a Clean Spark or a HUD 8 or something of the like, and they'll try to look for 100% or 200% return on their potential money, and at the same time get themselves into a company they don't actually care about, and the risk can be realized. It could go to $1 as opposed to 3 or 4. And in that case, they're stuck with buying a crappy company they didn't want to be invested in at all. And instead of making any money at all, now they're sitting on a crappy company that they didn't want to be involved in, and they didn't actually end up making any money at all. So I think, you really have to understand what you're getting in this for. And just because the money is there, just because that 20% return shows up, doesn't mean you have to take it. Think about what your objectives are. Think about how much time and management that might take, as opposed to just buying the stock and just letting it be as it is. You have to recognize you have to be a little bit more, I guess, on top of it, right? It's like relearning the stock market all over again. And it's going to take some failing, I would say, before you truly understand how to appropriately evaluate the risks that come with renting an option.
Yeah. And on top of it, that's the other thing that you told me, is that if the stock ends up going up and you locked in this 20% return, like let's say the stock goes from $4 to $10, and instead of like risking the capital on the put option, you would have taken a similar risk and just buy the stock on margin, you would have made like 150% instead of the measly 20% that you locked in. And in that case, you kind of look like an idiot, right? So that's like another reverse risk.
I wouldn't say that. I mean, I would say you would look like an idiot if you lied to yourself and you said, this is what my investing objectives are, and just because you saw that 20%, you went against your better judgment anyway, wrote the contract, and then said, oh shit, it went up 150%. That's when you would have cake on your face or egg on your head. That's where I think. But that 20%, like I'm more of a guy that understands that it's going to be difficult to achieve a 15 to 25% annual rate of return over the course of, say, 20, 30 years. And so I'm okay with something like that. And for me, I also already have 6,000 shares. So being able to write a contract, I wrote the $5 for, I forget what it was, February or something like that. And I was able to walk away with 30 something cents or something. And so I'm okay with it. Like it's a 5% return or something like that in the course of a month. And so for me, I wasn't too upset with it, because unless it goes below $5 again, I'm probably not going to buy shares. And I have to struggle with, should I just buy the damn shares as they are and get the 1,900 or 1,800 shares that I would be able to get, or should I wait until it's $5 and get 2,000 shares? So that's kind of where I'm at personally. But for me, I think that we're in a macroeconomic environment where the whole market will kind of come down. Granted, I might be next week sitting here like a dumbass because of the government contract outline here that we're supposed to have on Monday, and the stock might rally to $6 or $7.
The stock has been super irrational. So it could be that they like present on Monday, like this is how we will be cash flow positive and Neutron is on target, and then we just go 20% down.
It could. Yeah, it could very well do that as well. And then in that case, I'll be buying, $12,500 worth of Rocket Lab, and I'll be happy because, hell, I was able to get it at a 30-cent discount comparatively to the $5. So we'll see. But, you kind of have to look at things and take it on a case-by-case basis. But I think for most people take it slow. Don't willy-nilly enter into a contract. Or if you do want to be willy-nilly, do it on a paper account and truly understand, because I think a lot of people, especially when they just get into options, they think, okay, if I do a call, that means I want it to go up. If I do a put, that means I want it to go down. And that's not necessarily the case, right? It's very much about what you're doing with that option. Are you doing it for leverage? Are you doing it for hedging? Are you doing it for income? Are you doing it for, because you could be in a call option and you could want the stock to go down or up. And I don't think people recognize that, right? If you're the one writing the option, a covered call, let's say, you generally speaking want the stock to stay suppressed and to be able to collect that income, right? And same thing with writing a put. You might want to be buying the shares at a cheaper price, but you also might be writing it for income. Versus most people, I think when they think of a put, they're like, I have puts on the stock, they think it's automatically going to go down. So I think you just have to recognize what side of the trade you want to be on. If you're buying it, that means you're long.
Matt, your mic again. Something got unplugged. So some technical difficulties, but he will be back very soon. And yeah, this is also something, because we went a lot into writing puts, but other options that you can do is buying a call option, which I think is very, very risky, because then you have a time limit where you're trying to say that by this time the stock will be over this price. And I've had a very, very hard time predicting in the short term what the market is going to do. And it's funny, because when you sell options, you're trying to predict where the stock is going to be, like where the stock is not going to be, right? So if you write a call option, then you're saying that by this time, the stock is probably not going to be over this amount of money. And when you're writing a put option, then you're saying that what you're betting is probably the stock is not going to be below this money. Hello, Matt. Welcome back.
Hello.
So I was just saying that, yes, for example, when you buy a put or a call option, then you're doing this timing the market. And I feel that it's super risky, because you're like, put options can be great for insurance purposes, for example, that you have a very substantial amount of Rocket Lab shares, and then you're worried that they're going to go down, and then you can buy some out of the money put options. And then if the stock ends up going down, it's like an insurance, then you don't lose as much. Call options can be very, very risky, because then you're basically trying to time the market. And what I said is, when you buy options, then you're basically timing the market. And when you sell options, then you're basically saying where the stock is not going to be. So you're basically, if you write a put option, then you're betting that I don't think Rocket Lab is going to be below $5, but you're not saying where it's going to be, right? So that's kind of like the difference between the two. And so we covered calls and puts and selling puts, and then covered calls. It's very interesting, because that's something that very, very much scares me, because that's another one that can lure you in, because it seems like basically that you can only win. Like if we have Rocket Lab and you bought it at $4 or $5, and you write a covered call for $6 and you get paid, right? It looks like a deal where you cannot lose, because you either get the premium or the stock price goes up, and then you get to sell your shares at a profit. So it's like a win-win-win. But because we bought Rocket Lab because we think that it's going to be a fantastic future company, and if you write a covered call at, let's say if I would write a covered call at $10 and the stock would go to 15, not only would I lose out on a crap ton of profit, I would have to pay taxes, and I would have to buy back into the stock at a much worse price. So I just don't see the appeal in covered calls. Like for me, they're like the worst thing for the style of investing that I do.
Yeah, I use covered calls to a good extent in my portfolio personally, and I think it gets back to most of the time people don't have the discipline to truly write appropriate covered calls. And what I mean by that is they see the covered calls is the same thing. They see a 20% rate of return that they're going to be able to get, and they say, all right, I can lock in a 20% rate of return. Next thing you know, the stock moons because they didn't write the appropriate contract, or they wrote it around earnings season or something like that. And then they say, well, I don't want my shares to go away. It's like, well, then if you didn't want your shares to go away, you should have, like, the whole thing around options is that it's based around statistics, right? It's based around how many standard deviations will this move be away from the current price? What other opportunities are around there to move the price? And then obviously that's what the premium is kind of priced off of, and why people price them the way that they are. I'm a person that goes way out of the money. I own these stocks because I want to own these stocks, right? I want to own RKLB. I want to own Palantir. I want to own the S&P 500. I want to own all these opportunities. So I'm not going to let them go for a very cheap price. What I mean by that is I'll look for what is something that's likely to be 2 standard deviations out of the money. And that's going to be something that's like a 3-4 delta comparatively to somebody that writes something at the money. Yeah, you're going to make more money in the short term, but in the long term, I guarantee I can keep my shares, get a little. It's like a little dividend. That's when people hear me and Crossroads talk about Palantir dividends. It's because it's not actually something where I'm trying to print money, right? I'm not trying to print 5% a month, 10% a month. That's baby shit. I'm literally trying to get a portfolio size where I can make 1%, 2% additional a year, keep all my shares, still get all my normal dividends, and just get a little bit of extra on the top. Like I made 1.72% on my covered call income, but you have to think I have a pretty sizable portfolio that ends up being in the 5 figures, right? And I'm still keeping all my shares. I don't think I had any shares called away from me this year.
And what you're also not stressing is that you're passing up. Like you could write covered calls where it's like 5-6% return per month, but then you would be risking, like that's the trap here, that you're very methodical on choosing which option to.
And that might be appropriate for someone, right? Somebody that's looking for income, or somebody that manages it. TJ does that stuff, and I'm not saying TJ is wrong at all. It's just TJ is a very different investor than I am. I don't want my shares called away. If TJ gets his shares called away, I don't think he's going to be that upset about it. So you have to recognize what game you're in, why you're playing it, what you're doing. I mostly want to own my shares because I want to own them long term and see them appreciate, right? So I don't want to own my shares let them go whimsically for a 1 or 2%. I'm not chasing pennies when I could be losing dollars, right? I'm making sure those dollars stay intact. They're my golden geese, and I want to get my golden eggs. I don't want them to go away whimsically.
Yeah. I mean, we bought Rocket Lab, or at least me, and I think a lot of people in the chat, is because we see that this company can 10x and maybe even 100x if given enough time, and it would suck to have it called away from you because you were chasing a 3% return, and then you have to pay the taxes and then get back in the stock at much worse prices, at which maybe you will not do it because you're like, I'll wait for it to come down. And then what if it never comes down? I know people who are waiting for Palantir to come down since $9, and we're at 16.
Yeah. And that's why when Palantir runs up, I'm writing it at $23, $24. You see people, they're like, oh, my calls are underwater. It's like, well, why'd you write it at $16, $17?
But do you always write 1 month calls?
No, most of the time I write week. Depends, right? If it's a very large company like a Google, Amazon, I'll generally write something that's about a month out. The S&P 500, generally speaking, can term on a dime. The volatility of it's generally pretty low, but in terms of like in a month's time, the volatility can be very high. So I generally like to write my S&Ps to be a week. So I'm looking at the January 12s. I think I have some January 12s on for next week. Palantir, when it's appropriate, I don't write it because it's actually depreciated in value. So I'm not writing contracts here And same thing with Rocket Lab. I'm not looking to write any more contracts on Rocket Lab. I bought my sold my January 5th, which expired worthless yesterday. Pocketed a pretty good chunk of change, and I have some additional ones for next week as well for the $7, which, you know, that's why I'm a little bit scared for Monday, but that's only on 700 or 800 shares or something like that. So I should be okay. But you know, if I do find them, I try to write it as short as time as possible, because so much crap can happen, right? And you kind of limit your risk exposure if you lower the amount of time that you're exposed. So that's generally, and plus, if you're able to do it on a more consistent basis and ride that wheel, then you're going to be able to get more income out over the long term, right? Because there's a piece to say with theta decay, theta being the time component of options. And as Vince kind of alluded to, if you write a yearly contract, you might walk away with 20-25%. But if you're able to do a 6-month contract or a 4-month contract and be able to repeat it, if you can repeat it, then you'll be able to maybe squeak out 30-40%. So, for example, the February 5th puts that I wrote, on an annualized basis, if I were to able to continue that, I'd be getting closer to a 50% return, because I got it and it's a 5% return for mid-February timeframe. So I'm able to do that 12 times or 10 times. That's a 50-60% return. Vince, if he was looking at that, he was looking at 20-ish%, and locking in that 20%. So, you know, you're able to lock in that 20% versus me. I locked in my 5%, and who knows, you know, I might not be able to write it next month, or maybe it goes down to $4 or $5, right? Rather than the $4 or $5.50 that it's at right now. And I'm able to collect more premium. So that's the way I kind of like to look at it. You know, generally speaking, for covered calls, I do weeklies on stuff that is a little bit more volatile, small cap, and then larger cap, like Google and Amazon and stuff like that. I'll do 30 to 40 days out, and very far out of the money. Yep.
Cool. Very interesting topic. So we're not going to turn into an option channel here, but I thought that this was an interesting enough topic to discuss on Rocket Lab Weekly. So none of this was investment advice, and options are very, very risky investments. Definitely don't recommend doing them if you haven't done your research. So this was just basically food for thought for the viewers.
Yeah, and I will say the last piece to echo that. I know I've been talking a lot, so I apologize. You can lose infinite amount of money, literally, by writing options if you don't know what you're doing. So just like we talked about writing the $5 put, you might say, okay, well, I'm squeaking out a 20% rate of return, but in actuality, you can lose 80% of your money. You know, you could walk away with a $4,000 loss if you write 10 contracts on that. And you could sit there scratching your head like, I don't understand. And then same thing with writing naked calls, right? We talk about covered calls. That's if you own the shares. If you don't own the shares and you're writing on a margin account, this is what I did with GameStop. I was a dumbass. I didn't think that the stock would go above $150. And here I am waking up the next day. The stock was over $200. The next thing you know, I had to basically buy shares at 150 and sell them at 200. And instead I just bought the contracts back. But at the end of the day, you can lose infinite amounts of money. I thought I was going to be making 10 grand, and here I had lost 50 grand. So overnight, right? Whoa. So you have to think, I mean, you if you really don't know what you're doing, that's when I thought I knew what I was doing. And I wasn't and this is why I tell people this all the time. Sometimes we think we're smart enough to know what we're doing, but we're not smart enough to actually know the risks and uncertainties that we're getting ourselves into. So if you don't truly know that, and sometimes another piece is you don't know what you don't know. We talk about that at work a lot. At Undisclosed Oil Company, but it's like, you know, a lot of times we walk around thinking that we've been through life, we know this, we've been doing this for 5-10 years, and you can get slapped in the mouth pretty damn quick. You don't know what you don't know a lot of times, and that's part of the problem, and why some people think that they're going to be the next Warren Buffett, and then next thing you know, they get slapped with a 30% loss. So
yeah, it's so funny. I don't know which famous investor it was, but I read a quote that said something like, the risk is never what you think it is. It's always something that you don't know. And it's so funny because I have the exact same experience, that I've been in the real estate industry for the last 10 years. I've built many apartments. We have had many investors, and each project, when we do the presentation to investors, it's like, these are the risk points of the projects. And I can tell you, it's always something else. Like, it's always something effing else that you didn't think about, and there was no way that you could know it, you know. So I really started to embrace this viewpoint that even if you know, like Rocket Lab, we studied it so much, you know, we know the risk and know the plus sides of the company, but if it's going to fail or, you know, be a bad investment, it's going to be something that we were completely not looking at. We had no idea it was coming.
100%. Yep, 100%.
Cool. So I think it's a good point to end. I think this was super insightful. Matt, thank you so much.
No, I appreciate it. Sorry that my mic stopped working and I had to run downstairs to attend the barbecue.
No problem. We got some funny comments out of it. Some people wanted to sell puts on your mic.
Yeah, man, I don't know what the heck is going on. I don't know if it's because it's upwards, and I think it might be putting strain on this connection here, because normally I have it downwards, and I haven't had it disconnect if it's facing downwards. So maybe that's the way to go.
Huh? Cool. So thank you so much, guys. See you next week, and it's definitely going to be an exciting week. And see you on the next Rocket Lab.
Have a great and prosperous 2024, everyone. Thanks again, Vince, for having me.
All right. Thank you. Bye-bye.